Hey everyone, welcome to the Real Financial Freedom Podcast.
With your hosts, Diana and
Sam. Today we're going to interview a very special guest, Cherry Chan, real estate tax advisor, and we're going to discuss topics around the real estate investing and tax tips.
Tax is a big topic, so get your coffee, sit tight, get comfy, and enjoy.
Let's do this. Okay, so I wanted to give a very warm welcome to our special guest today, Cherry Chan. She's an amazing real estate tax advisor, a chartered accountant, and I wanted to give you thank you so much for joining us today on our podcast. It's a pleasure to have you.
Thank you so much for having me.
Yes, of course. It's been we've been trying to do this a couple of times, so I think it's we finally got to do this, and it's really a pleasure. And I think our viewers are gonna get great information out of this. This is information that everybody needs for the rest of their lives. So without further ado, let's get right to it. But before I do that, I want to just kind of introduce you because I think you're very special in this industry. I've been following you personally, and I learned a lot from you over the years. You're not just a tax advisor or a chartered accountant, but you're very like investor focused. You invest a lot in real estate yourself, and I think that's really important when you try to build a team of accountants, tax advisors, mortgage brokers to work with those who are also investor focused, because they know the ins and outs of investing, and they can tie it to their industry much better.
Oh, 100%. Always find it a lot more insightful when it comes down to advising my clients when you can speak with your experience. Oh, my experience is this. My experience for qualifying is that we need to, pay you less salary or pay you more salary. There are options available, and then we come to understand it a lot more intimately than regular accountants who don't focus on real estate investing.
Yeah, absolutely. And before we get started into like picking your brain and asking you questions, I wanted to talk about your books. You have a couple of books, and I think everyone should go out there and get it. You have two books. One is for real estate agents and Complete Taxation Guide to Canadian Real Estate Agents, and that's just how to pay less taxes and keep more commission. And you also have one for investors, Canadian real estate investing. And there's not too much out there. I've done research. There's not a lot of people who wrote books about the Canadian real estate investing. There's a lot of U.S. Books out there, but I think you're one of the few who wrote a book for Canadian real estate investors. So why don't you tell us a little bit more about your books and where our viewers can get those?
So you guys can totally get it off Amazon.ca, or I do believe that my website also carry the soft copies as well. We're just not carrying the hard copy ourselves. So the reason why I started thinking about putting the book together was really stemming from trying to find the answer to my question as a Canadian. Before I started my practice, I became, like, back in the days when I went to Waterloo, when I went for school, I was studying to become an accountant, and I became an accountant. And then I decided, okay, there got to be something more than just being a regular accountant working for a big corporation. So then I decided to jump off the ship and try real estate agent for a while. And I started investing in properties myself, and then make sure that I have some amount of cash flow coming in. And back then, the houses are not at the current level, so I actually still see some cash flow. So at that time, I started becoming a real estate agent, and then I realized there is not a lot of information out there to teach us or educate us whether you should set up a corporation or not as a real estate investor, or whether you should set up a corporation or not as a real estate agent. And that is at the time that I realized, hey, like, I study to become an accountant. I already got an advantage. And even as an accountant myself, I found it really difficult and challenging to find information. So I wanted to create a platform to educate people out there what we are doing, what we're doing with our clients. And hopefully, if you guys read my blog, and you will learn something from it. And so that's how I started my blog. And then in 2017, I put all these blog posts together in a more organized fashion and released that book. And I think 2020 and year 2021, actually not too long ago, I got a message from my team saying that it's still the best seller on Amazon.
Amazing.
That's amazing. Because
Congratulations on
I
that.
think a lot of people, they learn how to make money they learn how to generate money like real estate agents or even real estate investors. There's a lot of information out there on how to invest or how to make money in real estate, but nobody really understands the concept behind keeping your money and managing your money, right? So I think it's really important information to put out there, because I actually don't see a lot of this information. I don't see a lot of accountants putting this kind of information out there. So I think it's pretty amazing that you're allowing people to see this kind of stuff.
I'm not going to lie, it's a lot of hard work and commitment, publishing blog posts every single week for since 2014. End of 2014, I started it. So it's not an easy subject to explain and make it easy enough for people to understand. And I'm guilty of it. Sometimes I still speak at the accountant level, not the average people's level. And I think the world just needs more accountants to explain things in a simple terms so that they can understand better what their rights are and what traps are out there.
Yeah. And I think the first year of real estate agents or investors, they're always very shocked when they see their tax bill. And that's when they realize, okay, I better figure this out. Some people never do, but yeah.
Oh yeah, like I always remember the first year being a real estate agent, working on my husband's team at the time. Like I'm no longer a real estate agent. I don't want to be a real estate agent, but at the time I got the HST bill, I got the year-end tax filing, like the income tax bill. It was the first year, so I never really withhold anything. And I was shocked. I had to run out to do 2-3 more deals to cover the tax liability.
Wow.
Yeah.
So let me ask you this: like, how did you get into accounting, and at what point did you like feel like this is my passion? Is it like after you became a real estate agent, or was it something that as a young cherry, like you knew you're good at with numbers and all that stuff?
I started actually when I was in grade. I wanted to say when I was in grade 7, grade 8. And I was at the time I was in Hong Kong. And when you're at grade 7, grade 8 in Hong Kong, you are required to choose your major or at least a stream of studies. It could be either commerce, math and science, or art. Art is all about history. Math and science is all about math and science. Commerce is about accounting and economics. So I couldn't get into science. My marks weren't good enough. And art, I don't want to remember anything. So then I picked commerce. And that's how I started learning bookkeeping 101, bank reconciliation, and all these things back then, from like probably 14 years old. And then I came here. Naturally, I went back to what I did in the past. And I did really well in school in accounting as well. But then I got lost when I graduated, because when you work in the firm, we were put into these like good job, high paying job, to essentially do audit. I don't know if you guys are familiar with audit. Audit is basically taking and bobbing, like really checking if the receipts match whatever that's recorded in the books. And that was what I was doing. So I got really lost at one point. And then after the real estate agent test run, I come back to realize that, oh, hey, tax work is more interesting.
Right. It's kind of like it's scary when you don't understand it. Like I personally, not till a few years ago, like when I sat down with accountants, I felt like I have no clue what they're talking about. Like I left the room every time like less clueless, more clueless than when I walked in.
I didn't feel like I didn't understand. Like I actually didn't, because this stuff is not, unfortunately, in the Canadian school system. This stuff is not taught in schools, and that's one of the biggest things. Like I feel like in high schools they should be teaching you about tax, about investments, and how to manage your money or finances. A lot of people come out of school and they get jobs, but they don't know a single thing about income tax. They don't know a single thing about saving for paying your tax bill at the end of the year. So I think it's such an important topic, and a lot of people like you are passionate about tax, but a lot of people just don't really like it. But I feel it's such an important topic they should be teaching this very early on in schools.
Oh, absolutely. I think that investing and tax those are like really key concepts that they are missing right now in the school system. And I always believe that, like, all these successful people who actually never finished university, I don't necessarily believe that my kids would have to go through the university system to be successful.
Yeah.
And I truly believe that we as a parents, I don't know if you guys have kids, but I am a mom, and I wanted my kids to learn different things than what the school can.
Yeah, absolutely. I agree with you. I have 3 kids myself, and I feel like we have to teach them about investing, about taxes, about money, because the school won't teach you. Like they
don't,
removed that from the financial education from the school system, like more than 100 years ago. So if they don't want us to know those things,
They,
so we
well,
gotta
I mean, they're still
self-educate.
learning things like Shakespeare, which, I get it. It's, it's nice to know, but it's not really.
Well, thank God
it's not
for
gonna-
our times, because of technology, social media, YouTube, and individuals like yourself who is taking time out of your busy schedule to educate people about these things. It's so much easier than our parents and their parents' time, where they didn't have access to these things. So if they were not super passionate about a topic, to go and find all these secret books about these topics, which is so hard to find back in the days. Like these days, you could just, within a couple of clicks or just a smartphone, you can simply plug yourself into very useful information.
Oh yeah, this could be either your biggest asset or your biggest liability. It's
So now, like, let's go to the other question, which kind of ties into what we're talking about. Like, what made you, like, at what point did you get into real estate investing, and like, what made you so passionate about it? Because I know, following you, I know you do a lot of real estate investing personally, and you also work with a lot of investors. So, like, at what point did you get into real estate investing?
I think that was in 2022. 2000, no, not 2022. What am I thinking? 2012, about 10 years ago. So when, like you said, when we first graduated from university, we had no clue what's going on. There was like, what's the concept of saving? I do have some saving, but I didn't understand anything. So I wasn't investing. My best investment at the time was putting my money into my 2% PC saving account. I don't know if you know those high interest paying saving accounts.
Yeah.
Yeah. So then I decided at the time to purchase a townhouse, Toronto townhouse, with all my cash. At the time, it was $515,000. Today is worth like maybe 1 million, 1.2. I put all my money into that property, thinking that I'm signing my life away with the $400,000 mortgage, and then a year later, I came across a book called Rich Dad Poor Dad. And then I get to learn more about these, like, hey, Canada allows you to just put 20% down to purchase a property. And Canada banking system also allow us to refinance. Well, school never teaches that, right? So I actually didn't know. As an accountant, I'm shameful to say that, hey, like, I don't know anything about this. So I refinanced my home in a year. It has gone up to maybe 570 or 600,000. So I was able to pull out like maybe $60,000 from the appreciation. And I started investing in a property in St. Catharines. So I didn't know about refinancing, didn't know about Rich Dad Poor Dad, didn't know about investing outside of Toronto at the time. So then I went to St. Catharines and buy my investment properties, planning to leave my pretty cushy job at the biggest grocery chain in Canada at the time.
Nice.
What made you go to St. Catharines? Because it's true, like a lot of people at that time, with people that were in Toronto, were not really thinking outside of Toronto. What did somebody kind of tell you about the property? Did somebody show it to you? Like, how did you get there?
So how I got there was really just the Excel workbook. So people show me, actually at the time it was my husband who showed me essentially all the math around student rental area. So, but I remember I only have 60,000. It's not a lot of money. So $60,000 to invest at the time to buy another property in Toronto, it's almost impossible. So then I decided to find a place that I can actually generate sufficient cash to pay for everything. at least that's my bottom line. It has to carry itself. And then so that's the reason why I found either investing in Hamilton or Waterloo where I went to school, or in St. Catharines. And we ended up in St. Catharines.
Nice.
Awesome.
That's amazing. Thanks for sharing that story. Now, Cherry, let me ask you this. We have a lot of investors that come to us and they ask us, like, Sam, Diana, like, should we incorporate as investors? And these are like fairly new investors that are just trying to get into the market. But obviously, some of them have plans to grow and expand and compound their portfolios. So what would your answer be to like a new investor if they asked you, like, what are some of the questions I should ask myself if I want to incorporate as an investor, like get a holding company?
That is the number one question that I get asked all the time. So we came up with like about 7 questions that we ask the investors to consider it before they make the decision to set up a corporation. Like, for example, depending on the type of strategies that you're investing, some people love to invest in flips. So they buy and renovate and immediately sell it off, or they buy pre-construction and sell it and flip it before closing, because they actually don't have enough money or income to qualify for the mortgage. It's just that they know that it's going to go up. They want to sell before it's closed. So all these people, the money that they make are considered income, 100% taxable. And if they make a lot of money in their personal income, personal tax return, the government could take as much as 50% away from the profit that you make. So in that situation, we advise the client to set up corporation. So the second, which leads to the second question, how much are you currently making from your other source of income in your personal name? If you're not making a lot to begin with, there is less reason for you to set up a corporation. But if you're making a lot to begin with, there is more reason for you to set up a corporation. Now, the third question that we ask is, what's your long-term goal? How many properties are you planning to buy? Setting up a corporation costs money. That's just a given, because it's a separate legal entity. It files its own tax return. If you have big plans and you're planning to buy multiple properties and eventually you're going to grow it to something that you do full time, there is more reason for you to set up a corporation rather than not. And other question that we ask is how much risk tolerance you have. The higher the risk tolerance that you have, then the less likely you need to set up a corporation. That's just a given. And the type of property that you're buying student rentals, the type of investment that you do, student rentals is inherently a lot more risky than just having your condo renting to one person. It's very different risk profile. How much risk can you tolerate? And if you don't like the risk profile, you don't want it to affect any of your personal holding, then it's more likely that you should set up a corporation to protect yourself. And how likely are you planning to leave your assets to your next generation? So typically, if you want to pass your entire portfolio to your next generation, accountant often advise the use of some estate planning. And that estate planning usually involves the use of a corporation. And if you own everything in the personal name and transfer it over to the corporation, that trigger land transfer tax at that moment, at the fair market value. So you pay land transfer tax at the time when you purchase the property, and you pay land transfer tax again at the time when you transfer it to the corporation, even though there's actually no change of ownership. So these are all the factors that come into play in terms of setting up a corporation. That's why it's not an easy answer.
I want to ask something about a corporation. Like, let's say somebody has multiple properties, like they have 10, 15 properties. Do you recommend that they have like a parent corporation and then separate corporations for all the different houses? Like if one house goes under, you don't want the other houses to be at risk, right? Like how would you assess that?
Well, it depends on, again, the risk tolerance. There is benefit to own everything in one corporation, especially if you have a lot of properties. In Canada, in the corporation, rental income is considered specified investment business income, which is taxed at 50% first, and then 30% come back to you if you issue a dividend. I know I already lost you, but it's okay. Essentially, net amount that you need to pay in the corporation over the long run is about 20% inside the corporation. But when you take money out, you have to pay personal tax. That's a discussion later on. Now, but if you don't want to go through that system, 50% get 30% refund, you want to pay the small business deduction rate. Small business rate is 12.2%. The only way that you can do it is if your corporation, your rental corporation, hire more than 5 full-time employees. So for people who own a large portfolio of multi-units, they may truly need that 5 full-time employees. And if you have all these properties inside one corporation that allows you to hire that 5 full-time employees, you can lower your taxes a lot further, right?
Wow.
Now, on the flip side, though, for a lot of people out there, they're not really buying that many, can't justify hiring more than 5 full-time employees, then it comes down to the risk tolerance that you have. Do you want to put all your eggs in one basket? I have clients that put 10 properties in the corporation, same corporation, and it's truly fine with it. And I have clients who are like, well, I just want to put like 5 at max, and then I'll set up another corporation. And it also goes back to like the type of investment strategies that you have. Like I mentioned before, I invest in student rentals, and then I also own my office condo. But then the office condo, I have a commercial tenant that comes in. It's very low risk, but the reality is, hey, it's still commercial. Sometimes you don't, like, it's open to public. You don't know who's gonna come in and who's going to damage anything. So we specifically set up a corporation just to hold the commercial unit. So it goes back to the type of investment strategies that you're using.
Right. So like the pros is like when you bundle them up, you can use it. So you can essentially have 5 employees where you can to benefit from the lower tax brackets. And then the cons is like you may have some high risk factors when you bundle too many together. So you want to try to like bundle as many as, but it's got to be at a point where it's not gonna, the risk is not too high just to pay lower taxes, right? Is that correct? Like my understanding?
Well, yeah. So the reality is that even if you put 10 single family home together, they're just 10 single family home. It's not going to be enough to justify for 5 full-time employees. So even if you add another portfolio of another 10, so let's make it 20, it's still not enough to justify more than 5 full-time employees in that portfolio. Tax-wise, whether it is in one corporation or in like 5 corporations owning the same 20 properties, you still pay the same tax. It's just your risk tolerance level.
Got it.
Right.
Got
So
it.
sometimes you're better off just paying that additional tax and not having to hire, 5 full-time employees. Yeah, makes sense.
So what are some of your tax tips for like those that like to flip properties or like renovate, like rehab properties and then flip them? What are some of the tax tips you have for those people?
Lots, I have lots.
Like their top three tax tips.
Okay. So just understand that when you flip a property, the profit that you make is 100% taxable. That's very important. I think there is a common misconception out there that if you sell a property, it's going to be capital gain, which implies that only 50% of it is taxable. The profit, 50% of the profit is taxable. But the reality is, if you flip a property, CRA consider you being earning business income, operating a business intentionally, and business income is 100% taxable. So that's number one. Number two is that when we talk about flips, there are all kinds of flips. The best flips are the one that, hey, you buy at a low price and then just do some touch-up work, minimal amount of work, and then resell it for a way higher price. Now, those are fine. Residential resale typically are not subject to HST. But then there are those ones that also make you lots of money, but it requires a lot more work. You buy a really old house, you tear the whole thing down and you build a new house, or you buy an old house, a rundown house, and renovate and get the whole place and literally the whole place to resell. So in these situations, you may be deemed to be a builder in the eyes of the CRA. And that means you are building a new home. When you're a builder, whatever you produce, that particular house is considered a new home. When you're producing something brand new in Canada, typically is subject to HST. So that means you have to charge HST on the sale of the property. And guess what? Residential resale, you and I both know, you guys probably know it a lot better. On the regular residential resale agreement of purchase and sale form, it says that HST is included.
Right.
So guess who's going to pay for it? You as the seller. So it really comes down to documenting what you know and what you have done in the property to get away from that, to stay away from it.
Right. Okay. That makes sense. Thank you so much. Now here's another question that like I know there's a lot of misconception about this capital gain and income tax.
Yeah.
And like, yes,
That was my
specifically when it comes to pre-construction, we like, or people thinking if I live in it for a year and then after that I don't pay. So there's a lot of misconceptions, right and wrong ones. So at what point is it income tax and what point is it considered capital gain? Well, maybe we can start with pre-construction or assignment sales, for example.
Wow, this is a tough question because income versus capital gain is a huge topic and huge I wouldn't say litigated, but very controversial subject in the Income Tax Act. And there is also HST impact as well. HST is Excise Tax Act, so two different type of essentially tax act that we have to look into.
Right.
And the definition for each one may be different. Now, so let's just look at right now a pre-construction condo and you buy it. And you intend to move in, and just like every other pre-construction condo in Toronto is delayed for 5 years.
Right.
And so your life changed completely, and you decided that after closing, you're going to sell it because, well, I don't want this property. It's no longer fitting my goal and my plan. Now, in that particular situation, when you sell it, is it considered income or capital gain? Now, in that particular situation, you have all your life story planned out and you document your life story. I'm sorry,
Right.
Documentation is the key for CRA. And you could be eligible to claim it as capital gain if you sell it even if you sell it within 1 year. Now, if you immediately sell it within pretty much immediately after closing, within 1 year, CRA are going after those people who resell their pre-construction home or brand new home within 1 year because they are low-hanging fruit. It's
Right.
harder for the taxpayers to prove that their intention is to buy it as a long-term investment or buy it for self-use.
Right.
So
Right.
those are the low-hanging fruit. Now, is 1 year, does that mean that you just need to keep it for over 1 year and then you don't need to worry about it? No, unfortunately, CRA is just going after the low-hanging fruit. Now, if you live there for say a year and then you sell it immediately, and if you also have a pattern of doing that for multiple condos back to back to back, CRA could still come back to challenge you that, hey, you're doing it intentionally to make a profit and therefore you're not allowed. And therefore the income that you make is truly income. It's not capital gain. So then you can't even qualify to claim primary residence exemption.
Right.
How much do they have to pay on capital gains, more or less, just approximately?
Now, so capital gain tax, depending on how much you make. Now, let's say you make a profit from selling the property for about 100,000. Capital gain is 50% taxable. So only $50,000 is added to your income. Even though you make 100, only 50% of it is added to your income. And then subject to your personal income tax rate if you own it in your personal name. Now, if on the other hand, you earn income is 100% taxable. So all of a sudden you're paying tax on 100,000 instead of 50,000. That's why you always want to call it capital gain.
So it's always a benefit to have it considered capital gain versus going to your income because at least you're only paying on half of it.
Oh yeah, absolutely, 100%. But then at times, like you're really doing it as a business, then I have quite a few clients who truly do flips and they constantly flip properties. In those situations, there's nothing we can do.
Right. I think one thing I learned is like with taxes, a lot of people have like this way of thinking, like let me find loopholes and stuff, and I think like playing the game that way is very short term thinking, and I think eventually CRA is probably the biggest, like they're the richest people in the world. So there's a reason why they have so much money, because they know what they're doing, and they'll come after you and they'll catch you and you'll regret it and pay a lot more. I think the best way to look at it, which a lot of people don't, is play, how do I create a long-term strategy? How do I educate myself? Have a good tax advisor, a good accountant that can educate me on building, like creating a long-term goal, a long-term plan where everything is going like you're basically looking 20 years further ahead, 10 years further ahead. How do I want my goals to look like, my life to look like? And it's difficult for a lot of people, right? But I think that's from what I understand. What do you think?
100%. I mean, you could there back in the days, there were a lot of builders who tear down houses. I used to live at Leslie and Lawrence years and years ago, and there was this house that was down the street. It was a builder, tear it down, build a brand new home, move into it. And back then there is not as much focus on real estate industry as a whole by the government. So they lived in it, they sold it tax free because they claim it as primary residence. Now, can this happen today? You can still probably make the first deal happen. Maybe
Yeah.
if you're lucky. Now, but then over time, like you said, this is where you make your money, it's hard to just keep going with the second one, the third one, the fourth one. How do you consistently make that money and call it your primary residence? You can't. There are lots of court cases that are going after that.
And you're always looking in your rearview mirror. Like if you just have a proper strategy and structure have a proper tax planning, then you're never worried about anything because you're not trying to look for ways out. Your accountant has planned everything out for you, and your accountant can see 10, 20 years ahead. So they can plan you for anything that's going to happen in 20, 30 years. Like you say, it comes down to goals, right? What are their goals? What do they want to do? I have a question about passive income, because passive income in Canada and the US is taxed very different. And like Sam mentioned earlier, a lot of this information, like even like the Robert Kiyosaki stuff, Rich Dad, Poor Dad, is based in the US. But how is passive income, like rental income, taxed here in Canada?
So like I mentioned earlier, I use a different term because that's a proper tax term. But the reality is that in Canada, passive income in the corporation is taxed differently. It's taxed at that 50% initially, and then you can get 30% refund back when you issue a taxable dividend to the shareholder. So over the long run, inside the corporation, if you own these investments in the corporation, it's being taxed at 20% over time, because you will issue dividend to draw the money out to your personal name. Now, the personal side, when you receive the dividend, you will have to pay dividend tax. And depending on your tax bracket, it could range anywhere from 0% if you do really good job or structuring your company, or you spread out the income accordingly over multiple years. You can have your dividend income coming in as low as 0% or all the way to like 46% right now. So depending on the particular personal income tax bracket that you are in. Now, on the personal side, if you own these investments, the real estate investment, the rental property income or interest income or dividend income, if they are received in your personal name, it's basically taxed at your marginal tax rate. So in Ontario, the personal tax rate is a progressive tax system. Essentially, between $0 and $13,000, you don't pay any tax. Then $13,000 to like $45,000, you pay 20% tax. That delta pay 20% tax, and then all the way up to over 220,000. Anything over 220,000, you have to pay 53% tax. So depending on hey, I already have a job of up to $100,000 and I earn an additional $10,000 rental income. That $10,000 rental income is going to be subject to 43% tax, and depending on the person's original income that they already reported.
Right. Okay. So and then also one thing that's really fascinating is the whole concept of refinancing, which you kind of started with. Like it's pretty much like a tax-free way of getting money to reinvest, and a lot of people don't utilize this huge benefit. And the government is basically incentivizing people that, look, if you do this and invest it, like you're basically tax-free. So can you tell us a little bit like about if you're using tax-free funds to reinvest and what are some of the benefits?
So buying real estate, one of the biggest opportunity or biggest benefit of buying real estate as compared to like stock option or stock trading on its own is that you can refinance your property. The banking system allows you to refinance your property. What it means is that, let's say you buy a property for $500,000 and you close it, you have, say you have a $400,000 mortgage, which is 80% loan to value. Next year, it has gone up to $600,000. The government all of a sudden allows you to borrow up to 80% of the new fair market value, which is 600,000. So 600,000 times 80% is 480,000. Your first year mortgage is 400. Assume you never pay it off at all. So next year you can have as much as $480,000 as your mortgage. So after accounting for the initial 400, you still have that $80,000 that you can take out from the property, and you can use the money to purchase an investment property. Now, if you do that, and if your property, the first property that you own, is in your personal name, when you take out the $80,000, you don't have to pay any tax. You can just invest it in your next investment vehicle, and you can deduct the interest. Now, if you own the property in a corporation, when you refinance the fund, depending on your particular situation, you may be able to invest within you will be able to invest within the corporation without any tax implication, also tax-free. But if you want to take the money out, depending on your particular situation, there may be some tax implication on it.
Okay, that's a very interesting point. So if it's personal, no matter what the situation is, no matter what you do with the money, you can go on vacation, you can reinvest it, you can go buy a luxury car. It's tax free. But if it's in a corporation, depending on how you use the money, there could be tax implications.
So just a little bit of a correction there. If you refinance the property in your personal name, you use it for non-investment purpose. So you use it for your personal, for vacation, for buy a luxury car. The interest on that $80,000 in my example would not be tax deductible.
Got it.
Interest on that $80,000. Now, but then if you use that $80,000 for investment, then the interest on that $80,000 would be deductible. So it has to be for earning investment income. Now, if it is in a corporation, if the investment is in your personal name and you take it out, then depending on your situation, there may be dividend tax, but there may not be if you decide to invest everything in the corporation. So.
And then also the interest on personal, can the interest be deducted on a corporation as well when you reinvest it? The interest.
Yeah, absolutely.
And then also, so that interest that you're paying on the additional mortgage, so only on the 80,000, whatever the interest is, that's deductible, right?
Sorry, can you repeat that?
So like you're saying, remember we pulled out $80,000 for refinancing. On the interest we pay on that 80,000, that's tax deducted, right?
It is tax deductible as long as that $80,000 is used for the purpose of earning investment income.
So if you buy pre-construction, would that qualify? Or does it have to be like a rental property or a specific type of investment?
So to deduct the interest expense, it has to be earning income. So pre-construction is not income yet, unless your business is buying and selling pre-construction constantly, then it will be tax deductible. So depending on the taxpayer's particular situation, if you just buy it, I would at least capitalize that interest expense.
Okay, got it.
Mm-hmm.
That's
Got
the
it.
beauty of real estate's leverage, right? Leverage one property to buy multiple and multiple properties.
I think the next
Who,
question,
yeah,
sorry, go ahead, go
sure.
ahead.
Who can save for all these money? Like
Yeah.
an average Canadian salary is like $50,000, I believe.
Yeah.
How do you save $50,000? It takes years to save for that much money, right?
Yeah,
Yeah,
absolutely.
and the thing is, like, all it takes, and this is what I tell my clients, all it takes is one property. It takes one property and the rest is history. You refinance that one, reinvest it, then it's just a ripple effect. It'll just keep going and going. And like you say, the average Canadian, they're not able to save up because after the one property, you're probably having to pay 20% on the mortgage, right? So yeah.
So, Sherry, I have a question. I know in the US they have something called 1031 exchange. So when you sell a property and you take the profits and you put it into a new property, that tax kind of gets deferred until at one point you pull that money. Do you have anything in Canada like that?
That allows us to do that. So we
No,
should move to the States
unfortunately,
then.
no. So at one point, there was discussion, actually at the previous election, there was discussion by the Conservative Party. I'm not trying to get political, but there was it was actually one of the on one of the election platform, the Conservative Party proposed to allow investors only for rental properties to do the 1031 exchange, something similar to 1031 exchange, and defer the capital gain from buying and selling rental properties. But unfortunately, that didn't get carried through, and therefore there's like maybe in the future, because the government still has to come up with a solution to relieve the supply issue of our housing crisis. And it's not there, but it could be one of the playing cards that they can do.
Right. So at this point, like the only way to do something close to that would be refinancing, and like if you're gonna sell, you gotta have to pay the taxes here. But in the U.S., you can do something like that. Okay.
What would be your advice? Like, I talk to a lot of investors who, or people that want to get into real estate investing, and they're really scared of taxes. Oh, I have to pay tax on this. I have to pay tax on that. So they just end up not investing. What would be your advice to people who, young investors or people trying to get into real estate investing? What would be your advice to them if they have this like fear of of the tax man?
Well, I think that's where the education really comes into play. Like people need to flip the switch and think that, hey, in Canada, when you're paying tax, that means you're making money. Tax is just a part of your operating cost. I treated tax as one of my operating costs. I know it sucks. We have to pay it. It sucks. But does that mean that you're not getting ahead? No, you're still getting ahead. Maybe you're not keeping 100%. Maybe worst case scenario, you're keeping 50% because you give 50% to the government. You're still 50% ahead than when you first started. Is it worth it? Oh, 100%. Like I compare myself to my peers who do not invest in real estate, and it's a huge difference in terms of long-term wealth growth.
Yeah, I agree with you. I think it comes down to education, right? Like a lot of people are not educated, and when you're not educated, you're kind of it like this whole tax thing is very complex and scary to a lot of people. And honestly, like after you start learning the basic fundamentals, it's not as complex as people think. At least that's how for me, became like when I started learning a little bit more about it, reading a little books. It's like you gotta just learn the fundamentals and the basics, and then let your tax advisors and accountants do the rest for you. You know what I mean? So this way, at least you can have an educated conversation with them.
Absolutely.
And
Well, a
it's
lot of
not
people are
really
scared.
loopholes, right? Like it's like people call it loopholes, but the government has put these tax advantages out there for us to use. These are not loopholes. They're there to help us invest in more properties, because the more real estate investors we have, the more housing.
But I
we
think
can
it's also
supply
there
to
to
people.
help them, right? Like I think they're very smart. They put these incentives and tax breaks not because necessarily they like me and you and they want to help us. It's that they that's good for the whole society, the economy, right? Like they want those types of investors and people to do those things. So they're incentivizing them and giving them breaks. But for a long time, I didn't understand this. A lot of people, I'm sure they still don't.
It is a win-win situation. I mean, win-win-win if you think about the people who need housing too,
Yeah.
right? So
Exactly.
like I mean, yes, there's very little we can do about the tax part, but what we can do is to have a strategy and structure it in a way to minimize your tax. Just always keep in mind that, hey, you're making money, that's why you're paying taxes.
And
Yeah.
for all the young investors or any real estate investors, start off with Cherry Chan's book. You'll probably learn a lot.
Yeah, so
in
if
her
you're an
social
agent
media.
and you want to learn how to you want to not be scared of earning a lot of money and learn about the taxes, there's a book, Complete Taxation Guide to Canadian Real Estate Agents. She's going to teach you how to pay less tax and keep more commission. And for real estate investors, especially the Canadian real estate investors, go out and get her book, Complete Taxation Guide to Canadian Real Estate Investing. And you should follow her on social media. We're gonna put her handles somewhere on this video when we release it, and you should definitely follow her. She gives some really awesome tips, and I think I heard you call it. You want to be the Google. Can you repeat that?
Google Map for Canadian investors, hardworking Canadians seeking financial freedom.
That's right.
Love it.
So you
That's
should
amazing.
definitely follow her. She's gonna teach you a lot of stuff, and we thank you so much today, Cherry, for giving us this opportunity to interview you, to pick your brain, and to learn more about this very interesting topic of taxes and investing in Canadian real estate.
Yeah, it's been a pleasure. Thank you so much for your time.
Thank you so much for having me. I hope that you guys are not all bored to death yet. I
No.
hope that I simplify the taxes a little bit, and that's always my goal.
100%. It's
yeah.
you're very fun to talk to. You make it like much more easier to understand. So that's why I've been honestly following you, because when I watch your video, it's easier to understand it. Even once you learn a little bit, it's still like tax. You want to listen to it from someone who can make it more fun. So we thank you for that, and we'll definitely would love to have you back on next time. Maybe talk about specific topics that are more relevant to what's going on in the Canadian real estate market at the time.
Absolutely. Sounds great. Thank
Thank
you
you
so
so
much.
much. It was
Thank
a pleasure.
you.
Thank you.
Have a great day. Thanks so much.
Thank you. Bye.